Mode.
Hello and welcome to this month's Grow Your Law Firm webinar on structuring for succession. Quite an interesting topic that is often one of the issues that I talk with many of my clients about whether or not it's about a succession issue that they are currently working on, or whether or not it's just getting the practice structured now in a way that will allow them to uh, implement a succession strategy in a simpler way in the future. So part of when you look at structuring your practice for succession, you've got to look at quite a number of things. So first of all, what are those goals and objectives that you have within your practice? When are you looking at retiring, or when are you looking at bringing in new partners? All of those things. So you've got to get clear on those goals and objectives. Understanding, asset protection issues, taxation issues, debt strategies. And it's also an important part of your own business planning because when you get your structure right within your practices, you are able to implement some different strategies much more easily, particularly when it comes to funding and acquisitions and growth generally. So we're going to cover off a number of those things today. But before I get started, I'd just like to get a little bit of a feel for who we've got on a line today. So if you could just answer these few little questions for me. What best describes you? Are you a sole practitioner, 1 to 3 principal firm, or a 4+ principal firm? So just a couple more seconds there. Got a pretty good spread of people listening in today. So thanks for that. We have online today about 53% are sole practitioners, a third in the 1 to 3 principal firm size, so you've got to be 2 and 3, sorry, and 4+ are about 13%. In terms of what best describes you within your firm, are you a principal, are you a solicitor, being a non-principal, CEO, or practice manager? So I'd like to get this information just so I can make sure we tailor the webinar appropriately to those of you that are listening in today. So just another couple of seconds there. Thanks for that. So 70% are principals, and we've got 27% are non-principals, with 3% being CEOs and practice managers. Now, in terms of whether or not you've attended a Grow Your Law Firm webinar before, if you can just answer that yes or no, because what I'm going to be referring to today is a couple of past webinars that I'll direct you to have a listen to, because I'm just not going to go and redo some other information that we've already got there. So we'll just close that 50-50. So thank you very much to those continuing webinar participants that have attended our Grow Your Law Firm webinars in the past. Thanks for your continuing support. For our new listeners and new participants today, thank you for joining us on our website on financiallywellorganised.com. We've got a series of past Grow Your Law Firm webinars on quite a number of topics that you'll be able to go back and have a listen to if you like. So let's get into it. So when it comes to succession, those succession issues are when principals are coming in and out of firms. So principals buying into the firm, or principals exiting the firm, either in an amicable way or a non-amicable way. But the issues are always pretty much the same. What's the practice worth? Who buys or sells what? And how do we pay for it? So I'm not going to go into detail of this too much today. I'm not going to actually look at how you value your practice. I'm not going to look at how you, who sells what, and I'm not going to actually go into how you fund it. I've got a couple of webinars that we've done in the past on law firm funding, which will give you a good insight into how you can fund it, and also around how practices are valued. So hop onto our website at financiallywellorganised.com and go to our blog under the tab that says the latest, and you'll be able to search through there and find those webinars. So what we're going to be covering off today is a little bit of the mechanics of how structuring works, and some what I've seen and what clients of mine have had in terms of their experiences with looking at the structuring within their firms and what those opportunities are and what can be achieved. So with that said, I'm going to I've asked one of my clients to participate in our webinar today, Alistair Macpherson from Corney Lind Lawyers, who over about 12 months ago I worked on a succession strategy with Alistair and his partners at the time in terms of the orderly retirement of one of his the senior partner from the firm. So welcome, Alistair, and thanks for joining us today.
Yeah, thanks, Matt. Pleasure to come along.
Great. So we might just start by getting you to give us a little bit of an introduction to your firm. So if you can, just so that the listeners online today can get a bit of a perspective on who Corney and Lind is. So can you just tell us a little bit about your practice?
Yeah, sure. So we're currently a two-principal firm. So there's two of us as the directors and owners. We've also then got about 24 staff in total. 14 of those are fee earners, ranging from law clerks through to associates and senior associates and the principals and one consultant. I guess we have a focus on 6 legal areas, primarily in the not-for-profit and schools and education area client base, but also looking at commercial law and employment and discrimination law for them, and doing some family law as well.
Excellent. So
that's our practice.
Yeah. So you got a pretty specific but a generalist practice, I must say, in terms of when looking after your clients' affairs. You look after quite a wide range of different areas of law for them.
Yeah, that's right. Yeah. So we, particularly for our corporate and not-for-profit clients, we very much act in all matters that they require assistance in. Yeah,
great. So you're Brisbane-based?
Yeah, just outside Brisbane at Hurston.
Yep.
So yep.
Fantastic. So we met probably, I think it was probably about 18 months ago, I think it would have been. And when we met, you're a 3-partner firm, and you had a senior partner looking to gradually retire from the firm. So if you could just give us a little bit of an insight into what the challenges were that confronted the 3 of you at that time around succession.
Yeah, sure. So about 12 months ago, we were 3 partners. Each of us had an equal ownership in the partnership. We weren't an ILP at that time. We were just a partnership with a trust and service entity. All 3 of us were very much at varying life stages. Myself as the younger partner, and then an older partner who was looking to ease himself out of ownership and the pressures of ownership and start to transition to retirement. Some of the issues that we were confronting was around value, and I guess we all had some quite hopeful expectations about what the value of the practice was, but then as well how we would manage the senior partner's exit from ownership, how we would be able to fund the acquisition of his interest so that he would be able to achieve a fair value for his 1/3 interest, and at the same time safeguarding the goodwill in the practice and being able to see his continued participation in the firm. We also had some underlying real estate that we used, which was also owned by each of us in various degrees and interests through our self-managed super funds. And we wanted to be able to see an ability for us to take the real estate interests of the retiring partner and remove that and put it into some new ownership structure, which could then be controlled by the two ongoing partners. We wanted to avoid the problem of a consultant and employee of the firm in an ongoing capacity, also being a landlord. So that was some of the issues that we needed to get our way through, and to find a way through that importantly preserved relationships for all involved.
And I think that's probably one thing that's, that last point you said, Alistair, that I think is really important with what I see in firms that are looking at succession issues. The main driver of whatever strategy that is implemented always seems to be the continuing goodwill around that relationship, because principals have been in business together for a long, long time, and whatever the strategy is that needs to be implemented to achieve those outcomes, it's got to be done in a way that makes sure it's a win-win-win. So a win for the continuing principals, a win for the exiting partner or the partner entering, and also a win for the business, so that whatever the strategy is for achieving this succession sets the business up in a way that takes into consideration those future goals and objectives. So Alistair, I might just now, if it's all right with you, just run through some of the types of strategies that we looked at with your firm, and I'll go through in a little bit of detail though of those, so that everyone that's listening on board can get a bit of a picture around how we solve that. So Alistair, stay on the line. I'll come back to you shortly.
Great.
So just before we get started on that, just so I can get a bit of a feel for whether or not you've got some existing succession issues that are happening at the moment. So just very quickly answer that question. Is this something you're considering? Have you got those succession issues that are red hot in your firms at the moment? Or whether or not that's something you're considering that you need to be looking at into the future. So thanks for that. We've got about 42% of yes and 58% of you saying no. So what we're going to be running through is some strategies that are relevant for succession, but they can also be just as relevant for your normal structuring of your firm. And lastly, just so I can get a bit of a feel for what the number one issue is for those of you who have got a succession strategy at the moment, what you see is that number one issue that is your major concern for you. Is it how you fund it? How do we work out the value? How do we structure it? What do we do with the tax? And they're just four of what I see as the main issues that we often have to address. So just a couple more seconds there. Okay, so thanks for that. So, often it's value and structure, and that's what comes through loud and clear in those answers. We've got almost 75% of the attendees today saying that it's value and structure are the two big issues. So let's run through a little bit of that. So the mechanics of how you restructure, or you look to the structure of what happens with an exiting or an entering principal. So basically, you have an old practice, and that practice will have goodwill, fixed assets. It'll have staff and equipment and leases. It will also have work in progress and debtors. And generally, what we find is that firms that have existed for more than the last 15 years, or say in New South Wales, or if you're in Queensland, that have existed before 2007, a lot of those firms are old traditional structures, and those structures generally will be a partnership of individuals and with a sole trader, with maybe a service entity. In some instances, they may be a partnership of trusts, but generally, what what we find around succession is that the time of succession is a great time to have a look at what the appropriate practice entity needs to be going forward. And what we find is when there's a new entity that's set up that's going to be the continuing entity, then that new entity would generally buy the old practice goodwill, the old practice fixed assets, and assume the various leases and employee entitlements. What happens in the old firm, it would generally retain its work in progress and disbursements. It would also retain its own debtors. So basically what happens is within the old firm, a line's drawn in the sand either at the exiting of a principal or of the entry of a new principal. The old firm's working capital assets stay with it, and the goodwill, plant and equipment, employee entitlements get transferred to a new entity. So when you look at the structure of your practice, so as I said, it's usually we find that at this point in time when there's a succession happening, that's the time when we look at what the appropriate entity needs to be. So, Alistair, your practice was a partnership of individuals with a service entity, and I can remember our first one of our first meetings in my boardroom where the three of you were there, and I floated the concept of an incorporated legal practice to you at that point in time. And what we ended up doing is restructuring your practice into an incorporated legal practice. What have you seen? What have you seen as some of the benefits of operating your practice as an ILP over the last 12 months?
Yeah, look, I think one of the first benefits is that it's simplified things significantly. It's simplified the way in which we deal with third parties. We've got a very clear corporate structure that we can hold out. It's also simplified the way in which we deal with taxation, and I think as a result of all of that, it's freed up cash flow for us. It's simplified our relationships with our financier, particularly in that regard, and freed up that cash flow as part of that relationship being enhanced.
Yeah, so it's often one of the conversations that I have. Why would I bother having an ILP? It just seems more trouble than it's worth. But I think the experience that you've just outlined there, in the main, is the experience that most firms have. So just moving forward from there, we can have a look at what entities you might consider as your future new practice entity. And partnership of individuals. The trouble you got with partnership of individuals is they are quite tax ineffective. So the tax effectiveness of a partnership of individuals is very low. In addition, you've got joint and several liability. And you still have a stamp duty issue that you need to have on the transfer of those fractional interests of an entry and an exiting partner. So partnership of individuals were the norm for most firms pre-incorporation. Number of firms had partnership of trusts, which operated similarly to the partnership of individuals. However, it allowed distributions of profitability over a range of beneficiaries. Of more recent times, partnership of trusts are on the nose with the ATO, and over the last 12 months, the ATO has issued various materials on their views of professional firms operating through partnerships of trusts. Also, what happened, we used to be able to use corporate beneficiaries quite effectively, but post 2009, the rules changed in relation to Division 7A, which made corporate beneficiaries less attractive. for utilisation of the corporate tax rate of 30%. And look, service entities, a good number of years ago, the tax office basically said we don't like them, so we're going to issue a ruling which generally make most service entities a waste of time. You know, the level of profit distribution that you can achieve out of a service entity is quite low. So it then raises a question, you know, what's the other alternative? And the other alternative really is around an incorporated legal practice. And as I said before, the question that I often get posed is it really worth the effort? You know, we've got to restructure, we've got to have a look at paying stamp duty. And I think what happens with most firms is that they don't necessarily consider what the other advantages are that you have in implementing an ILP as a structure, as a new operating structure at that point in time of succession. So we're going to run through that in a bit of detail. What I see with most new firms that are established these days, they're automatically an ILP. So when you've got non-principal solicitors or principals of firms exiting firms and establishing new firms, nearly every time those firms are established as a company. With old firms that have existed with pre-ILP law, there's the opportunity to restructure. Now that opportunity exists whether or not there's succession happening or not, but it needs to be done with caution and with care to make sure that you're very clear on what the impact and the outcome is. By old firms restructuring into companies, it allows the retained earnings that they have, or the retained profits that they've built up in work in progress and debtors, and in relation to debtors that they've already paid the tax on in a lot of cases where they do accrual accounting. It allows the opportunity to cash out those retained profits and develop a new funding structure for the firm, the new firm going forward. So it allows firms to make a decision, well, are we going to now keep those retained profits that we've built up over time and utilise them personally, or how much of those retained profits are going to be loaned to the new entity, so that we've got some cash flow there to fund the new entity's growth in WIP and debtors, and how much are we going to fund via debt. Companies are a much easier way of funding new partners. Basically what you do is and I'll run through this in a moment, you look at restructuring the goodwill of your practice into a new entity, because when a practice is sold from one related party to another, then for both capital gains tax and for stamp duty purposes, it needs to be done at its market value. So you have an ILP that's purchasing an asset, and you're able to fund that. So that debt can be funded via either bank debt or by a vendor finance. And what it allows to happen then, it allows that value for the existing principals of the firm that's locked up in goodwill. It allows that to be utilised by those principals for other purposes, some of which may be a superannuation strategy. So I see a lot of firms where the principals have got significant amounts of their assets tied up in their working capital assets, their WIP and debtors and unbilled disbursements. I see that they have got a minimal amount or lower amounts sitting within superannuation, and all their equity is tied up within those working capital assets, but it's also tied up within the goodwill value in their practice. So what can happen when you restructure your firm, you're actually able to unlock some of that value, and often you can utilise it via getting some of that value into superannuation in a very tax efficient manner. So there's some of the things that I see as opportunities there for older firms restructuring. So let me just take you through how that works. And this is just the normal sort of restructuring transaction that happens within firms. So first of all, the old firm retains its work in progress and debtors, and as they're collected and billed out, the old firm principals receive those WIP and debtors. They'll then, as I said before, they'll make a decision as to whether or not they're going to keep that themselves. They'll have some tax to pay on it, but they'll make a decision whether they keep that or whether or not it gets lent to the incorporated legal practice to fund its work in progress and debtors that it bills. Often what happens is then you're able to go to the bank and you will borrow money to purchase the goodwill, office equipment, and also to sometimes fund your growth in your work in progress and your debtors if the old firm has decided to retain its working capital. Now, what happens with banks, and and I've done a webinar on funding for law firms before. What a lot of firms don't realise is banks are actually there to lend money. That's how they make their money, and that banks value legal practices as a very viable industry for which to lend money to, and they will often provide only require security, being the practice assets to fund that debt. So, Alistair, you mentioned before that you've by moving to a corporate structure, that your banking relationships changed and were simplified with your particular bank. Can you give us a little bit more of an insight into what simplified it, or what achieved those outcomes for you?
Yeah, sure. Look, I think it was a couple of things. First of all, we used the whole process to change away from one of the traditional 4 large banks, which unfortunately we found was more fixed in the view that they took, and I guess their willingness to support us in what we were trying to do, and moving to one of the other banks just gave us a greater ability to have something set up that better suited our needs.
Yeah, I think
they were more willing to work with us.
I think the difference there, Alistair, is you moved from a bank that didn't have a policy around legal firm lending to one that did. So they actually understood the transactions, didn't they?
That's right. Understood the legal practice environment. So we found it was just such a breath of fresh air, really, to be dealing with a bank that was, I guess, really willing to work with us. Yeah. And to help us to achieve what we wanted to achieve. And then from there, they really did help us set up the various financing and necessary to help the practice grow.
Yeah, exactly. They got what you're about, and have helped you fund that growth. And I think the important thing also was is in those relationships with your bankers. When you get the right relationship there that understand your business, and that they're very viable businesses. Legal firms have been around for a very long time. They've got very reliable cash flow. When you've got that relationship there, it is a load off your mind, knowing that you can you've got that support. You can go and implement the strategies that you want to.
Yeah, absolutely, Matt.
Right, mate. So you go to the bank and you get your loan. So just to continue on with that, what happens next is you may have a bank that will lend money to the shareholders as well. So if you've got an incoming partner, they may also loan money to the shareholders, who then either put that in as a loan or equity into the ILP. And what happens then is the ILP will then purchase the goodwill, on office equipment minus employee entitlements, back from the old principals. So what these transactions allow to happen is that it allows the value of the practice being locked up in goodwill and WIP and debtors, unbilled disbursements, to be unlocked. And as I said, that can be unlocked either via lending from a bank, which can be then used by the principals of the old firm, or the old firm principals can provide vendor finance. So if you've got that circle there that says bank, it can be done by vendor finance just the same. So what it does, it produces that opportunity to access the equity in your firms that you've spent a lot of time building up, to put to some different use if you choose. So the opportunities for principals within an ILP, it produces a tax rate of 30%. So when you're either growing your work in progress and debtors, or you're retiring debt, you get to do that in a 70% after-tax environment, as opposed to your marginal tax rate environment, which in a lot of instances, I have firms that are growing their WIP and debtors and funding principal repayments out of a 46.5% tax environment. Same amount of income, but they just have less after-tax cash flow to fund those actions. It allows the shareholders of the company to be discretionary trust, so it gives some other level of asset protection, but it also provides an ability to distribute business profits to other family members. Now, something that you've just got to be mindful there in looking at business profits versus personal exertion income. For a company to be able to be taxed at 30%, you need to have at least the same number of non-principal fee earners as you do for principal fee earners in the practice. If you're a sole practitioner, and you've got a legal secretary, and that's how you operate your firm, a company may not work as well for you. So you just got to be aware of that. It allows you to unlock your after-tax retained earnings that you've got locked up in your work in progress and debtors. It allows an opportunity to provide funding for new principals into the firm, and it also allows you to fund the retirement or exit of old principals from within the firm. Some principals who have got personal debt in their own name, what some firms do is they take the opportunity to restructure their practices to clear some non-deductible debt, but also to restructure some deductible debt that they have got secured against their homes, get that restructured into the practice, so that the practice is just used as security for that debt. And sometimes, depending on the transaction, sometimes that can be achieved with limited guarantees being provided. It also provides an opportunity for principals to access tax-free capital gains and to start developing superannuation strategies by putting by having some of their passive investments within the either 0% or 15% tax environment within superannuation. And it also, as I said earlier, it allows debt reduction to be in a 70% tax environment. So what I want to work through now is just some simple numbers, just to give you a little bit of a perspective, because what I see with firms when they're looking at what their structures should be, whether it's with regard to succession or not, is you've got to do the cost-benefit analysis. And what I see as the main impediment for firms is the amount of stamp duty that they perceive they have to pay. And as I've said earlier, you usually only pay stamp duty on the value of your goodwill and your office equipment. WIP and debtors and unbilled disbursements generally stay outside of the new practice entity. It just stays with the old partners, and so there's no stamp duty payable on that. What you've got to look at is you've got to look at what the possibilities are that exist for you within your firm. So what I've got here is just a little calculator that I use to assess that. And I'm going to just take you through a little exercise where we look at a practice that would be just traditionally structured, where you'd have a partnership of individuals with a service entity, where there's a small amount of service entity profit that's generated, so that the majority of the the income in that or the profits that are generated in that practice are taxed to the principal, simply because those practices were structured that way prior to practices being able to incorporate, and have just continued on to do so simply because of not taking the opportunity to restructure. So we're going to have a look at that. So we've got here, say, a practice that makes $950,000 worth of profit, and we've got three principals in that firm. So within that firm, each principal is making just over $315,000 worth of profit. This firm, as I said before, has a service entity where there's only about 5% of those firms' profits end up being within that service entity. So that the income that ends up being taxed to the principals of that firm is about $300,000, and only about $16,000 that gets distributed to other non-principal relatives like spouses and so on. In this particular firm, let's just say there was an earnings multiple of 3 times in working out the value. So with this particular firm, let's say it had an estimated goodwill value of $1.5 million. That gave a goodwill value per principal of $500,000. And in this particular instance, if we're looking at it on an individual principal basis, this individual principal had a $450,000 non-deductible home loan. That was or non-deductible rental holiday home, credit card debt, whatever it might have been. But they had some non-deductible debt for about $450,000. So what that means is, if we're looking at that $450,000 being repaid over a 10-year term, then the pre-tax income that is required to be earned to pay the non-deductible principal repayments is about $103,000 per annum. So out of the $316,000, $103,000 has to be earned, paid tax on, generally at 46.5%, that you then use to retire your debt so that it gets paid off over a 10-year period. If we also then just had a look and said, well, if we were to have that profitability structured within a company, so that debt becomes tax deductible, and that the debt gets repaid out of in a 30% tax environment. And if we looked at the related parties, they had an average tax rate of 25% on their income, and were able to split that income between two people, beneficiaries, instead of the majority of it just being split. The majority of it just being taxed to the partner. Then what we see is a series of savings that can be achieved. So over a 10-year, if we're looking at a 10-year term on the loan, then just by restructuring that debt on exactly the same profit, there's about $80,771 of after-tax cash flow over the first 5 years that is available to be used for some other purpose. So simply by not having non-deductible debt in your own hands and having that deductible debt being repaid in the 30% tax environment, on exactly the same amount of pre-tax income, you end up keeping another $81,000 of that to apply for some other purpose. So if you look at the tax savings, if you didn't apply any debt, if there wasn't any debt restructuring, then in year one you're going to have a $15,000 tax savings on your income simply by the ability to split your income. But if you are able to restructure your debt so that non-deductible debt is then tax deductible and you can claim interest, then your tax savings in year one become about $34,000 when combined with income splitting. And if you were then to apply these after-tax cash flow to additional deductible super contributions, then in year one you're going to get a benefit of about 36. But if you applied that over the term of 10 years, then out of exactly the same amount of profitability that you're earning, just by having your debt structured appropriately and by having the right structure for your practice, then you can generate a tax savings of up to between $78,000 and $156,000 by using those these assumptions and based on those numbers. So when you look at what the opportunities are that present to you in whether or not you restructure your practice, you've got to look at all of those sort of things. How do we incorporate a good superannuation strategy? How do we incorporate a good debt structure into the practice? And compare all of those things to the only real cost when you set it up being the stamp duty that you pay, which in this instance would have been if these are these are savings and benefits for a single principal, then for that one single principal transferring $500,000 of value, the stamp duty on that's about 20 grand. So in most instances, it's very rare where these sort of circumstances exist. It's very rare that the benefits that get provided in year one are less than the stamp duty that it costs you in year one. So what I'm saying is what you've got to do is you've got to take into consideration all of those benefits and not just focus on the stamp duty costs there. So superannuation's another great opportunity that you need to take into consideration when we're looking at this. And Alistair, we incorporated in your strategy some superannuation where you had a number of properties that were owned, strata properties owned over a number of different entities. If you don't mind, would you mind just sharing with us just a little bit of an insight into how that worked and what the outcomes are that were achieved there around your premises restructure, and also how we looked at solving some capital gains tax issues with the rollovers?
Yeah, sure. We had a number of units within a body corporate that we were using for our business that was owned by each of the partners in varying degrees. So what we looked at was taking this as an opportunity to move all of the real estate holdings into one self-managed super fund, and then acquire a large portion of that from the exiting partner, which gave us the opportunity to then build our those partners who were remaining the opportunity to build their own self-managed super fund portfolios and build towards our own retirement. The benefit as well is that particularly for my other business partner, he was going to have a capital gains tax liability coming out of the purchase, and he was then able to effectively roll over into his stamp duty a large portion of what he was getting out of the transfer, which then helped us fund some of the purchases and also helped us fund ongoing purchases in our super fund. So it really gave us the opportunity to build our respective super funds and look towards retirement with something significant being built away.
Yeah, and look, I think the key was it was considering that as part of the overall strategy and as a solution for dealing with retiring partners' interests in those premises. But we were able to do it in a way that we mapped out that plan, if you remember, right from the outset, so that we could build that into the funding mechanisms for the restructure.
Yeah, and we were quite impressed with the fact that really by the time we'd set it all up, the rent that we were paying, which we were already had factored into our cash flow from previous years, was effectively going to pay off the principal and interest loans in the super funds over a period of 10 to 15 years.
Yeah, I think it's pretty less than 10, I think, compared to having to pay it out of those higher tax environments.
Yes.
So thanks, Alistair, for that. So I just want to take everyone through just very quickly and a bit of an overview of how this works. So when you look at super, you've got two things that we can consider here: premises restructure, where you've got interest with other partners, or even if you're looking at buying premises. There's small business capital gains tax rollover exemptions, which allow you to roll over money into superannuation. If you're under 55, then you've got to put the money into super. If you're over 55, you don't have to put the money into super, but if it's part of your strategy. And what it then produces for you, it produces the whole restructuring strategy produces more after-tax cash that, if you choose, you can use to fund more super contributions to further build your wealth within super. So just to give you an example, the ILP sells some goodwill. The ILP buys goodwill, which means the principal sells it, so they'll get some cash from that. The bank lends money to the superannuation fund for purchasing the property. What then happens is, from the sale of the goodwill and from the sale of the property, there may be some capital gains because they're business premises and because goodwill is a business asset. Those capital gains can be, provided they meet the small business capital gains tax exemptions, which the majority of lawyers do. Those can be then rolled over into self-managed superannuation fund tax-free and have that property purchased from the property owner. The outcomes that it produces, just as a simple strategy, is that the rent then gets taxed either in a 0% or 15% tax environment, which gives you a greater amount of after-tax return to retire debt. Assets within the super fund have got that level of asset protection. Generally, you can do it without there being any capital gain from the practice restructure, and it's also a good mechanism for creating a funding mechanism for your retirement. So, by unlocking some of your asset value that you've got tied up in WIP and debtors and in goodwill within a firm, whether you're the retiring partner or a continuing partner, it allows you to really work on those strategies to fund your retirement. So, Alistair, just to wrap up, we're just about out of time. If you can just give us a little bit of some closing comments in relation to the sort of the outcomes of the process that we went through, and what was achieved, just to wrap up, and what it's then allowed your firm to do. So just a couple of closing comments. Thanks, mate.
Yeah, sure, Matt. Look, I guess when we were going in, we were fairly daunted with the whole process and just how complex it appeared to be, and the fact that we would need to involve our financiers, and then actually we had to decide to move financiers, which was a whole other process and quite a daunting process to think about. And also we were really concerned about whether we'd get to the end and have been able to preserve relationships, particularly with the exiting partner. I think looking back, we can certainly see that we achieved all of those goals, and it really did provide us with an ability not only to get the practice into a much better structure for the two partners moving forward, but also then to be able to fund further growth and build for our retirement in the self-managed super funds. So I think it's really been a process that, while it involved costs and time and effort, that the real advantages and benefits, particularly in the mid to longer term, greatly outweigh those costs and that we had to put in at the outset.
Yeah. No, it's always important to always important to start with that end in mind as to what those outcomes are you're wanting to achieve, and then make sure whatever the strategy is that you implement is built around achieving those outcomes. So, Alistair, thanks for your participation today. Really do appreciate it. A bottle of red wine is on the way, mate.
Thanks.
We'll see you soon. For everybody else that's listening in today, as always with my webinars, I always make an offer at the end of it for the first 15 to email me at matt@fwo.net.au for a free 45-minute one-on-one succession strategy review, where I'll just get a little bit of information from you, and we'll block out 45 minutes and just have a talk about what those issues are that you've got in your practice, whether it's around succession or whether it's around structuring, funding, tax generally. Just email me, and we'll get that scheduled in. For those of you who are interested, my next FWO Growth Club is kicking off in May. FWO Growth Club is profit and cash flow strategic planning that I work with on firms in a one-on-one basis and as a group over a 12-month program. So if you're interested in that or would like to get some more information, just register your interest by emailing me at matt@fwo.net.au. I'd also like you to draw your attention to a new website that we launched as part of our major sponsorship with the Queensland Law Society Symposium this year. It's growyourlawfirm.com.au. This is a content-based website where we will be providing lots of content via tutorials, workshops you can run with your team, calculators and tools that will continue to build over time, that all of our clients get provided free of charge. So it was only launched about a month ago, and we'll be building and growing that as time passes on. So from 1 July, it'll be a subscription base that our non-clients will be able to also access. So it's free to do so at the moment, no obligation. So go in, growyourlawfirm.com.au, have a flick through, see what's there, register up for it, and just use that. So, look, thank you very much for your participation today on succession strategies for your practice. As I said, if there's anything you'd like to, talk about, just email me at matt@fwo.net.au. Our next month's Grow Your Law Firm webinar, I'll be revisiting funding strategies for law firms, putting a little bit of a twist on that, so you can see what's possible in terms of funding arrangements with your bankers, and what sort of outcomes you achieve. So thank you very much for your participation today. See you next month.